Rick Larkin here, host of BCB Live, the safest station in the nation. If you don't already know about Freight and Review, it's a segment I cover once a week where I analyze freight rejections, freight tenders, driver productivity, and much, much more. You can watch Freight and Review on LinkedIn, Facebook, or YouTube. So what are you waiting for? Subscribe today and follow BCB Live. Hey, welcome to BCB Live's Freight and Review. I am Sir Rick. Coming to you on a Halloween Monday. Good Monday to each and every one of you. Gonna jump in real quick. We're gonna take a look at what's going on right now. We look at the trucking pricing right now. Now, what I'm referring to are those used truck prices. We see from March, and that's that peak right here. It's all gone down. That 3-year-old truck back in March was worth about $143,000. Today, it's down to $112,000. Same thing goes for that 4-year-old, down to $87,000, and the 5-year truck, yes, you got it, $69,000. Pricing's going down. Let's just look at the last year. We can see how that wave has gone up in the last year. It went all the way up in March, and it's on its way back down. If you look at that 5-year basis right now, man, it is crazy to think what we used to pay, normally paid for a truck, and that price was right here, closer to that $65,000 for a 3-year-old truck. Went all the way to $143,000. Today, once again, going down to $112,000. The markets are still kind of nuts, right? You think about it, those that bought last year are struggling right now, going out of business as we speak. Many of them going out, right? Even those that bought even in February, March, April, having the same struggle with rates going down, fuel prices going up. We're going to keep looking at that as we talk about fuel pricing. Look at what we've seen over the last month. We saw that decline, and I'm going to break it to 3 months. Remember, we were bragging, we were happy. We saw fuel pricing going down from $5.33 a gallon down to about $4.80 a gallon. It was a crazy, and we were excited. It seemed like the independent contractors were maybe making money again. Well, if you look at the last month alone, we've gone from that $4.83, $4.85 mark all the way up to $5.35 a gallon. So we go back and we think about it, okay, the truck prices are going down. If you have that extra capacity today, those open trucks, you're going to try to sell them today, know that market is really getting watered down right now. If you go back and you say, well, you know what? If the fuel pricing's going up, well, Sir Rick, certainly that means that those rates are also going up. And my friends, let me tell you something. We look at the last month, we saw the prices on fuel go up from $4.83, $4.85 all the way to $5.35 a gallon. We'll look at the pricing on that spot market freight. And that spot market freight's what most of you out there are chasing. And who I'm talking to are those independent contractors, right? Those with 1, 2, 3, 25 trucks, maybe even 50 and 75 trucks. You live more on that spot market side. We saw prices go in the last month from $1.95 down to $1.74. You've seen the pricing go down on that market. Line haul rates are down. Fuel is up. Just a huge double whammy. Now it's not just for that smaller independent contractor, right? It's for that medium-sized trucking company. That 100, 125, 150, 175 trucking company. They are feeling it right now as we speak because their spot markets are going down. Their fuel costs are going up, and they don't have the same fuel discounts that the big boys, the larger shippers have. And here we go. We're going to keep going. We're going to keep looking at what's going on right now. All right, and here we go. We look at the contracted rates right now. Now, here's the interesting thing. We go back and we look at those with the contracted rates still hovering around that 268, 270, 273-ish mark. So those with that contracted rates are going to stay in business right now. They're going to be okay, right? And why do I say that? Well, if you go back and you go back, let's go back much further than last year. Let's take last year out of it. 2020 doesn't really count, right? That COVID year 21 doesn't really count. We want to get back to that 19 and 18. We want to see what was going on back then. 268 is your rate right now. So the trucking companies, the brokers, but let's just talk to the asset side. Those folks right now, they're charging 268 a mile, much higher than that spot market. And you got to say this, well, Sir Rick, fuel affects them as well. Not necessarily. The more contracted freight that you pull, the more you're protected from that fuel surcharge, right? That fuel influx. You are protected. 268 a mile. And if you go back and you normalize every other year other than the COVID year, I mean, we're at 215, 220-ish a mile. So rates have gone up. Those contracted carriers that are pulling that freight are able to stay in business. And some of the things they're doing to ensure they stay in business and to, maybe they're not running as much trucks, right? Because freight has gone down. They're finding other ways to supplement that income. Specific to the brokerage side, if you can take a load at $260 a mile, broker it out for $1.80 a mile, that's called margin. Heck, you can give $220 away and you're still making the margin plus fuel. That's what you see that asset side doing right now. Why do we say that? Well, here we go. Let's look at the last year. We're going to just purely look at the last year just so we can remember what we're talking about here. It wasn't just a year ago that we were hovering now towards that 16,000, maybe 16.5 shipments per day. If you go back to today, we're at 11,651. Significantly less freight moving today than what was moving last year. And if we go back and say, okay, well, let's look at the last 6 months, Sir Rick. See if I can get that to work. If we go back and look what's happened over the last 6 months, again, we can still see freight started dropping off, right? It was at that 12,005, almost 13,000 shipments. Today, it's really moved down. However, I will say this, it's staying above that 11,000 mark. 11,000 mark to me is a critical, it's a critical number, okay? It's the difference in really, the freight really starting to tighten up much more so than what we've been used to. If we can stay north of 11,000, we really want to be in that 12,000 mark, we will be okay on that asset side of the business. The contracted side of the business. There is a difference between the contract, the large carrier, the large broker, and those that are just purely living off that spot market. I've shown you that side. And when you see all of that freight that's being tendered out today, right? When you go back and let's look at a year ago, when we had 16,000 loads being shipped out a day, we also had rejection rates near that 23%, meaning 23%, 22%, whatever of record volume was being rejected. Today, we're not at record volume. It's still good though. And I'm going to go back and show you that the good volume, only 4.5% of that is being rejected. Only 4.5% of that 11,500 shipment freight is being rejected. What does that do? Well, it presents just that much little freight being offered on that spot market freight. You go back again, you think a year ago, 16,000 shipments, 20, 22, 23% rejected rate equaled a bunch of spot market freight. Today, 11,500 shipments at only 4.5% being rejected creates that very low spot market freight, which means that there's a lot of smaller carriers fighting for the same freight, dropping that price down even though fuel's going up. When we go back and look at that outbound tender volume, I keep saying it's not that bad. It's significantly worse than it's been, at the beginning of the year, though. We do know that, right? Year to date, freight was up here at 15,000, down to 11,500, 11,600 shipments. Let's go back and look at the history, though. Normally, we look at the freight. See if I can get my crosshairs going here. There we go. We look at, here's where we are right now, the white line going across. Look at every other year, these blues right here. Those are the volumes that are under. So back in 2018, 2019, normal freight, it's closer to 10,000 shipments a day being shipped out. We're still at 11,500, 11,600 shipments. So significantly higher than what we've seen before. It's different though. Make sure you're ready to go. We're going to kind of let this month play out. I'm going to come back probably again after that Thanksgiving mark as we see the freight moving out. Some things that I think about right now is that peak season. Are we going to get a false sense of getting busy? And I feel like it's kind of there right now. We see freight moving up, right? I mean, we're up to 11,600. If we look at the last month, freight is moving up. My question is this, and I gather that from the inventory levels across the country in the warehousing right now. We're moving up. We're at almost 72%. Here was the peak back in March, right? It came down, and we thought inventory levels were going to just go off, fall. Well, here they are going back up again. That just really tells me that still today, there's a lot of warehouses holding on to that inventory that they bought last year with record prices, with record rates, with record containers coming from China to the United States. At some point, they're going to let that go. My worry and my thought process right now is when we start letting that inventory go, right? Maybe it happens. Maybe the TJ Maxx has a record year. The Walmarts, the Targets, Amazon say we've got to release this inventory that we're sitting on. We as a trucking company, we as a logistics industry, we may feel all of the sudden that freight is getting heavy. And although it's freight that's been in here for a while. And my concern isn't necessarily fourth quarter, is what happens first quarter. Because here's what we do know, is that we're not bringing that same replacement freight out of China back into the States. We don't necessarily know what's coming out of Mexico into the States that's been repurposed. We know it's a lot more freight than last year. I don't think it's the same amount of freight that we're losing out of China right now. We see the pricing on the same containers that last year they were paying $20,000 for, today down to $4,500, $5,000 a container to move that freight over. The inventory replacement's not coming in. That first quarter of next year, February, March, if we empty out this inventory right now, that's my concern for us on this logistics side for next year. If the people aren't buying, or if they're spending out and raking up them credit cards right now, we continue to see the interest rates going up. At some point, we stop buying. First quarter next year, that's where my eyes are at. I think we finished this year still fairly strong. Next year, that's the year we have to look at. I am Sir Rick for BCB Live's Freight and Review. We'll see you in a couple of weeks.